While the financial media celebrates new stock market highs, a pattern is emerging in the data that almost no one is discussing publicly. High net worth households increased precious metals holdings by 23% in a single quarter. 67 publicly traded companies now hold Bitcoin on their balance sheets. And central banks purchased over 1,000 tons of gold last year alone. This isn't speculation. This is coordinated positioning by institutional capital, the kind of positioning that typically precedes something they see coming that you don't yet. Welcome to Boring Currency Matters, where we discuss what they're not telling you about your money. If you've reached a point in life where you value intelligence over entertainment, where you want economic analysis that doesn't insult your experience, then you're in the right place. Consider subscribing, not for hype, but for the kind of strategic warnings that might actually matter to your financial future. And let us know in the comments, where are you watching this from today? We're building a community of serious thinkers, and we'd like to know who's paying attention. In January 2025, analysts at the Federal Reserve published routine household balance sheet data. Buried in the technical tables, a number appeared that didn't make sense. Households with over $1 million in investable assets had increased their precious metals holdings by 23% in just 3 months. Not over a year, not gradually, but in a single quarter. For context, that represents the fastest quarterly accumulation rate recorded since the Fed began tracking this metric in 1952. This wasn't retail investors panicking on social media. This was wealth moving quietly. At the same time, another data point emerged from Coinbase's institutional custody division. Corporate Bitcoin Treasury allocations had grown 340% year over year. Publicly traded companies, the kind with boards of directors and fiduciary responsibilities, were converting cash reserves into Bitcoin at a rate that would have seemed absurd just 36 months earlier. 67 corporations now hold Bitcoin as a balance sheet asset, not as speculation, but as treasury policy. These two movements, gold accumulation and Bitcoin adoption, were happening simultaneously among the same type of actors: institutional capital, family offices, corporate treasurers, the people who manage serious money for serious organizations, with serious consequences for being wrong. But here's what made the pattern unusual. The financial media wasn't discussing it. CNBC was running segments about artificial intelligence stocks and real estate recovery. Bloomberg was analyzing Federal Reserve interest rate projections and unemployment data. The Wall Street Journal was publishing op-eds about equity valuations and bond market opportunities. Nowhere in the mainstream financial discourse was anyone asking the obvious question: why are the people who actually manage large pools of capital moving that capital into assets outside the traditional financial system? This creates what intelligence analysts call an information asymmetry. One group knows something and is acting on it. Another group doesn't know and continues operating under old assumptions. History provides reference points for this type of divergence. In the fourth quarter of 2007, while financial media celebrated housing market strength and banking sector profitability, high net worth investors were quietly reducing equity exposure and increasing cash positions. 6 months later, Bear Stearns collapsed. In the first quarter of 2020, while public health officials were still calling COVID-19 containable and markets were near all-time highs, institutional capital was moving into defensive positions at rates that wouldn't become obvious until the March crash. The pattern repeats. Informed capital acts first. Public awareness comes later. By the time the average investor understands what's happening, the strategic positioning has already occurred. So what makes 2025 different? The speed. Previous cycles of defensive positioning took 12 to 18 months to fully develop. This time, the accumulation phase compressed into quarters, not years. Something about the current environment was causing sophisticated actors to move faster than historical norms would predict. And there's another element that makes this pattern unique: the dual asset approach. Traditionally, when institutional capital seeks safety, it moves into U.S. Treasury bonds, the risk-free asset, the foundation of global financial architecture. But this time, they're moving into gold and Bitcoin instead. Not bonds, not cash. Assets that exist outside the banking system, outside government control, outside the traditional monetary framework. This suggests something more fundamental than a typical recession hedge. When investors buy Treasury bonds, they're still expressing confidence in the dollar system. When they buy gold, they're expressing doubt about that system. When they buy Bitcoin, they're expressing doubt about the system and seeking a digital alternative simultaneously. The combination of both gold and Bitcoin together represents preparation for a scenario where the traditional monetary architecture itself becomes unreliable. This isn't conspiracy theory. This is observable data, verifiable allocations, published balance sheets, corporate filings, Federal Reserve statistics. The evidence is public, but the interpretation isn't reaching public discourse. which raises the central question that frames everything that follows. What do institutional allocators and high net worth family offices understand about the current monetary architecture that hasn't yet reached mainstream financial analysis? What information asymmetry are they acting on? And more importantly, what specific systemic vulnerability are they preparing for? In March 2024, the World Gold Council published its annual central bank survey. The headline number stopped analysts mid-sentence. Central banks had purchased 1,037 tons of gold in a single year, the second highest annual total in recorded history. But the real story wasn't the volume, it was the buyers. 9 of the top 10 purchasing central banks operated outside the Western monetary system. China's People's Bank, India's Reserve Bank, Turkey's central bank, the National Bank of Poland, the Central Bank of Russia. These weren't random purchases by isolated actors. This was coordinated behavior across multiple jurisdictions with a common strategic objective: de-dollarization. The term sounds abstract, academic, something discussed in policy papers but not reflected in real markets, except it is reflected in tonnage, in vault transfers, in bilateral trade agreements that bypass dollar settlement entirely, when Turkey and Russia agreed to settle natural gas payments in gold-backed instruments, when China and Brazil established direct currency swap lines eliminating dollar intermediation, when the BRICS nations announced plans for a commodity-backed settlement system at their January 2025 summit. These weren't symbolic gestures. These were infrastructure decisions, the kind that take years to reverse once implemented. Now consider what was happening simultaneously in corporate America. In 2020, a software company called MicroStrategy made an unusual announcement. They were converting $250 million in cash reserves into Bitcoin. Financial analysts called it reckless. The CFO explained their reasoning in a quarterly filing. They viewed holding dollars as the risk, not holding Bitcoin. They weren't speculating on Bitcoin going up. They were defending against the dollar going down. 4 years later, that decision looked less like an outlier and more like a template. 67 publicly traded companies now hold Bitcoin as a Treasury reserve asset. Tesla, Block, Marathon Digital, Riot Platforms, Coinbase itself, but also companies outside the crypto industry entirely. Medical device manufacturers, real estate investment trusts, technology firms with no connection to blockchain technology. Their boards of directors, people with legal fiduciary responsibilities, had approved moving shareholder capital out of dollars and into a digital asset with only 16 years of existence. Why would risk-averse corporate treasurers make that decision? Because they'd done the same calculation the central banks had done. They looked at dollar supply expansion. They looked at debt trajectory. They looked at political willingness to impose fiscal discipline, and they concluded that holding cash was the greater risk. This represents a profound shift in institutional thinking. For 70 years, since Bretton Woods established the dollar as global reserve currency, the default assumption was simple: cash is safe, everything else is risk. Now that assumption was inverting. Among the people who manage the largest pools of capital on Earth, cash had become the risk position. But here's what makes this particularly significant. These actors weren't choosing between gold or Bitcoin. They were choosing both. Central banks buying gold, corporations buying Bitcoin, family offices allocating to both simultaneously. This dual asset approach reveals something about the nature of the risk they're hedging. Gold represents 5,000 years of monetary history. Every civilization that's ever existed has recognized gold as a store of value. It requires no counterparty. It has no default risk. It cannot be printed, diluted, or debased by government decree. When an institution buys gold, they're saying, we trust the oldest form of money more than the current system. Bitcoin represents something different. It's a digital bearer asset with programmatic scarcity, 21 million coins, hard-coded, unchangeable. No central bank can print more. No government can inflate the supply. It exists entirely outside the traditional banking infrastructure. When an institution buys Bitcoin, they're saying, we need a monetary alternative that functions in a digital economy, but operates outside government control. The combination of both assets in the same portfolio reveals the specific scenario being hedged. They're not preparing for a stock market crash. They're not preparing for a recession. They're preparing for a loss of confidence in the monetary system itself, a scenario where the dollar's role as reserve currency comes into question, where the Federal Reserve's ability to maintain stability is doubted, where the entire architecture of dollar-denominated finance becomes unreliable. This explains why sophisticated investors aren't waiting for confirmation of crisis. By the time the crisis is obvious, the defensive positioning becomes impossible. Insurance must be purchased before the event, not after. And there's one more signal that makes this pattern impossible to ignore. Pension funds, the most conservative institutional capital in existence. entities with legal obligations to retirees, operating under strict fiduciary standards, prohibited from speculation. The Houston Firefighters Pension Fund allocated to Bitcoin. The Wisconsin Investment Board took a position. The State of Michigan Retirement System disclosed holdings. These aren't venture capital funds taking flyers on emerging technology. These are institutions responsible for paying benefits to retired public servants. The fact that they're moving capital into assets outside the traditional system tells you everything about what they see coming that the financial media isn't discussing. The question is no longer whether institutional capital is positioning defensively. The evidence is conclusive. The question is, what specific vulnerability in the monetary system are they defending against? The United States Treasury Department publishes a number every month that most people never see. It appears in routine fiscal reports, updated automatically, barely mentioned in financial news. In January 2025, that number crossed $36 trillion. The total outstanding federal debt of the United States government. For context, in the year 2000, the total debt was $5.7 trillion. In 25 years, the debt multiplied by a factor of 6. But here's the part that changes everything. The interest payment on that debt now exceeds $1.2 trillion annually. That's not spending on programs. That's not infrastructure or defense or Social Security. That's just the interest, the cost of servicing the existing debt. For the first time in American history, the interest payment on federal debt is larger than the entire defense budget, larger than Medicare, larger than any single line item in the federal budget except Social Security. And here's where the mathematics become inescapable. That $1.2 trillion in annual interest has to be paid somehow. The government has three options: raise taxes to cover it, cut spending elsewhere, or borrow more money to pay the interest on the money already borrowed. Tax increases of the magnitude required would collapse economic activity. Spending cuts of the necessary size are politically impossible, which leaves only one option: borrow more to pay the interest on existing borrowing. This creates what economists call a debt spiral, a self-reinforcing mechanism where the debt grows independent of policy decisions or economic conditions. The debt requires interest payments, which require more borrowing, which creates more debt, which requires larger interest payments, which requires even more borrowing. The cycle feeds itself, and it accelerates, because as the debt grows, the interest burden grows faster than the underlying economy. Now add another data point into this equation. Since February 2020, the M2 money supply expanded by 41%. M2 represents the total amount of dollars in circulation: checking accounts, savings accounts, money market funds, the actual supply of money in the economy. 41% expansion in 5 years. During that same period, GDP grew by 18%. Notice the gap. Money supply grew by 41%. Economic output grew by 18%. That 23-point gap represents pure monetary dilution. More dollars chasing roughly the same amount of goods and services. This is the mechanism of currency debasement, not through official devaluation, not through dramatic policy announcements, but through quiet expansion of the money supply at rates that exceed economic growth. Every dollar in existence becomes worth less, because there are more dollars competing for the same underlying economic value. This explains why someone who saved $100,000 in 2020 now needs $141,000 to maintain the same purchasing power. The number in their bank account didn't change. The value of what that number represents declined by 23%. Now consider what this means for the bond market. U.S. Treasury bonds are considered the foundation of global finance, the risk-free asset, the benchmark against which all other investments are measured. But in August 2024, something broke in the Treasury market that required Federal Reserve intervention. Traders call it the basis trade crisis. The technical details are complex, but the underlying message is simple. The Treasury market, the largest and most liquid bond market on Earth, experienced a liquidity crisis, meaning there weren't enough buyers at existing prices. The Federal Reserve had to step in as buyer of last resort. This wasn't supposed to be possible. Treasury bonds aren't supposed to have liquidity problems. They're supposed to be the most liquid, most reliable, most stable financial instrument in existence. The fact that the market required emergency intervention suggests structural problems beneath the surface. And then there's the yield curve. For most of 2023 and early 2024, the yield curve was inverted. Short-term interest rates were higher than long-term rates. This is historically unusual and typically precedes economic contraction. But what makes this cycle different is what happened next. The curve steepened dramatically in late 2024, but not because long-term rates fell. Long-term rates rose, while the Fed was cutting short-term rates. This creates a contradiction. The Federal Reserve was trying to ease monetary conditions by cutting rates, But the bond market was pricing in either deflationary collapse or inflationary escape velocity. Both scenarios are catastrophic, just in opposite directions. Now add the political dimension. There is no serious proposal from either major political party to reduce deficit spending. Democratic proposals require continued spending. Republican proposals require continued spending. The mechanisms differ, but the fiscal trajectory is identical regardless of who controls government. This removes the traditional constraint on monetary excess. Historically, political pressure eventually forced fiscal discipline. That constraint no longer exists, which brings us to the international dimension. At the January 2025 BRICS Summit, 9 nations representing 45% of global population announced development of a gold-backed trade settlement system. Not gold-backed currency, gold-backed settlement for bilateral trade between member nations. This allows direct trade without dollar intermediation. China sells manufactured goods to Brazil. Brazil pays in a gold-linked digital instrument. No dollars involved, no SWIFT system, no exposure to dollar inflation or U.S. monetary policy. When this infrastructure becomes operational, the structural demand for dollars declines, and when demand for dollars declines while supply continues expanding, the mathematics become unavoidable. The question facing informed capital isn't whether the monetary system has structural problems. The question is, what happens when those problems can no longer be papered over? The executives sitting in corporate boardrooms aren't economists. They're not monetary theorists debating abstract policy. They're operators responsible for businesses, employees, shareholders, and quarterly results. When they look at the data just outlined, they face a practical question, not an ideological one. The question is simple. How do we protect the capital we've accumulated when the monetary system itself has become the risk variable? This requires inverting traditional investment logic. For decades, the framework was straightforward. Preserve capital in cash and bonds. Take risk in equities and alternatives. The foundation was stable, so you could afford volatility in the growth assets. But when the foundation itself becomes unstable, when holding dollars means exposure to 41% money supply expansion, when Treasury bonds require Federal Reserve intervention to maintain liquidity, the entire framework inverts. Cash becomes the risk position, and assets outside the system become the preservation mechanism. This is why sophisticated allocators are moving 5 to 15% of portfolios into gold and Bitcoin, not as investments, as insurance. The distinction matters. An investment is purchased with the expectation of profit. Insurance is purchased with the expectation of protection against loss. No one buys fire insurance hoping their house burns down. They buy it so they're protected if it does. Gold and Bitcoin function the same way in this context. They're not bets that these assets will go up. They're protection against the purchasing power of dollars going down. Gold provides the historical anchor. For 5,000 years, across every civilization, gold has maintained its function as a store of value. It requires no counterparty. A gold coin in your possession has value, regardless of what happens to banks, governments, or financial systems. It cannot be printed. It cannot be diluted. It cannot be seized remotely through monetary policy. When someone holds physical gold, they hold an asset that exists outside the banking system entirely. This is why central banks buy it, not because they think gold will appreciate, because they know it preserves value when confidence in paper currency declines. Bitcoin offers something complementary. It's a digitally native bearer asset, meaning it can be held directly, without intermediary, just like physical gold. But it functions in digital commerce. It has programmatic scarcity, 21 million coins maximum, hard-coded into the protocol. No central bank can change that limit. No government can inflate the supply. No emergency monetary policy can debase it. For businesses operating in an increasingly digital economy, this matters. Gold is excellent for wealth preservation, but difficult to transact with in modern commerce. Bitcoin preserves the scarcity principle of gold while functioning natively in digital infrastructure. Together, they provide coverage for both analog and digital collapse scenarios. Now here's the timing paradox that most people miss. Waiting for confirmation that the monetary crisis is real defeats the entire purpose. If you wait until Treasury bonds are in free fall, if you wait until inflation is visible in consumer prices, if you wait until the dollar is losing reserve currency status, the defensive positioning becomes impossible. Everyone will be trying to exit at once. Prices will reflect panic, not strategic accumulation. Insurance must be purchased before the fire, not during. This is why corporate treasurers and family offices are positioning now, in early 2025, and when financial media is still optimistic. So what does this mean practically for business operators? First, restructure how you think about reserves. Operational cash should remain in dollars. 3 to 6 months of expenses for immediate liquidity needs. But strategic reserves, capital held for 12 months or longer, should be diversified outside dollar exposure. 5 to 15% in hard assets is the range most institutional allocators are implementing, not 50%. Not speculative bets, insurance-level positioning. Second, understand this isn't about making money. This is about not losing purchasing power. If gold and Bitcoin simply maintain value while the dollar declines, that's a successful outcome. You're not trying to get rich. You're trying to stay even in real terms. Third, monitor specific signals that indicate systemic stress. 10-year Treasury yields spiking above 5.5%, gold to silver ratio moving above 90, Bitcoin institutional custody growing faster than 20% quarterly, Federal Reserve balance sheet expanding during non-crisis periods. These indicators tell you whether the defensive positioning is working or whether additional action is required. The savvy American investor in 2025 isn't making a bet. They're reading the same data the institutions are reading. They're observing the same positioning the central banks are taking, and they're drawing the logical conclusion. When the people who manage the largest pools of capital on Earth are moving that capital outside the traditional monetary system, it's not speculation, it's recognition. The dollar's purchasing power trajectory is structural, not cyclical. The debt spiral is mathematical, not political. The monetary expansion is policy, not temporary emergency measure, and the appropriate response isn't panic. It's preparation, quiet, strategic, defensive preparation, the kind that ensures when the system experiences stress, your capital is positioned outside that system, not trapped within it.